registered investment advisory complex or financial advisors, and particularly in the U.S., have either an intentional ignorance or misunderstanding of gold or a deliberate desire to keep it off of their clients' thoughts, which is a fascinating thing, and it's not a tinfoil-hatted conspiracy theory. That gold is, I think, deliberately misunderstood in the industry. Gold, of course, is a direct threat to the U.S. dollar, and the U.S. dollar is key to the Fed's survival and policies. It's certainly key to the political survival of who's ever in the White House, and the less people understand about gold, the better. Again, that may sound sensational, but when we went off the gold standard in 1971, the biggest fear at the Eccles building at the White House was, what is the gold price? What is the gold price? And if you understand the State Department and the Treasury Department's policies post-71, it was a deliberate effort to keep gold off the headlines and also to keep the gold price artificially repressed. That is no longer fable but fact. And that repression mentality has tricked down not only from the LBMA banks on the COMEX or the London exchanges, which for years have tried to manipulate the gold price. It's also trickled down into the portfolio level for private wealth management offices at commercial banks and at Main Street commercial banks, and also just at your kind of bread and butter registered advisement office. So there is a deliberate misunderstanding of gold, which I find fascinating. And if you take away the conspiracy theory or the bias of a gold bug, and you just look at what has happened in just the last 24 years, this century, the quarter of a century, gold has outperformed the S&P and so many other asset classes, yet no one's talking about it. Just this year, gold's up over 33%, and yet no one's talking about it. Investment advisors say gold is too risky. It has the largest Sharpe ratio macro on the planet. It's far less risky and volatile than a lot of the sectors in the S&P and the Dow, and yet, according to the wealth advisors, it's just too risky. It reminds me of that scene in Gladiator where he says, "Are you not entertained? Are you not entertained?" Gold has done so well without having to be called a gold bug risk asset. It simply has been more stable than most other risk assets like bonds and equities. And it's also outperformed in terms of its staying power any currency, any paper currency on the planet Earth. And since 1971, when we got off the gold standard, the US dollar's lost greater than 99% of its purchasing power against a single milligram of gold. So when you ask why isn't gold in more portfolios, I think you should ask your portfolio advisor. It may be an ignorance, it may be a direct ignorance or an indirect lack of knowledge, but if you just look at the past performance in the last quarter century, it's clearly obvious that your advisor might have missed something in not allocating. It doesn't mean it's the only allocation you should make, but it certainly has outperformed other asset classes that very few people understand the reasons why.